Welcome, everybody. This is Buck Joffrey with Consensus Network. And today I want to start out to remind you that we do have this website called consensusnetwork.io. And if you have an interest in going there and taking some of our tutorials just in terms of potentially buying your first little bit of Bitcoin or how to trade it, etc., check it out. Very simple to use, nicely done little tutorials by Phil Chan. Also wanted to let you know that there is another podcast that I do, in case you didn't know. It's called Wealth Formula Podcast. So if you are somebody who is trying to figure out how to invest outside of this crypto world, I do a podcast that's really focused on investing outside of Wall Street in what traditional folks call alternative assets, which is really just, real estate and real stuff that you can, feel and touch and smell and all those things that have made people a lot of money over the centuries. And anyway, check that out. It's called Wealth Formula Podcast, and is available in all the same places that this podcast is available. Now, as far as today's show, I don't know if you've noticed, but people or companies especially are overusing the word blockchain. In fact, I read an article recently that exposed 12 publicly traded companies that reaped huge valuation rewards. I mean, their stock just skyrocketed simply by adding the word Bitcoin or blockchain to their name, even if they had nothing to do with Bitcoin or blockchain. Now, listen, this technology that is coming through is special. I think that's why I'm doing an entire podcast on it. I have no doubt about that. But even actual blockchain projects may not have a real reason to include consensus and permissionlessness and all these attributes of blockchain. But and so part of what we've got to do is to flesh out over the next decade which projects actually benefit from the technology. And so in our job in the meantime is really to understand the technology as well as we can as investors, to make sure that if we are investing in a project that utilizes distributed ledgers, it actually has purpose. My guest this week on Consensus Network is somebody who's very good at that sort of thing, particularly in identifying what use cases are, what's real, what's not. He is a very impressive guy who can think both at the macro level, is sort of a philosophical approach to this space, and combine that with really sharp analytical skills that he used at Fidelity. His name is Nic Carter, and he is going to help us navigate through this rapidly changing world of distributed ledger technology when we come back. So welcome back to the show, everyone. Today, my guest is Nic Carter. Nic is a partner at Castle Island Ventures. And before joining Castle Island, Nic worked for Fidelity as their first crypto asset analyst, where he devised research perspectives on public blockchains. He's also the co-founder of Coinmetrics, a platform devoted to demystifying on-chain data and bring transparency to the industry. He's written extensively about token holder rights, crypto asset governance models, and public blockchains as political institutions. Nic, welcome to the program.
Thanks for having me on, Buck. It's a pleasure to be here.
So I don't want to get too sort of pedestrian here, but I just did notice that you have a master's in philosophy. So how do you go from a master's in philosophy to the digital asset space?
Well, that's actually kind of a quirk of the Scottish university naming system.
Okay.
That would be equivalent to an undergraduate degree here.
Okay.
It's just that at certain Scottish universities they call it a master's, which is very confusing.
Okay.
But I studied philosophy undergrad. Particularly was interested in epistemology, the sort of the theory of knowledge, and political philosophy. I think there's a lot of crossovers there,
Yeah.
particularly when you're designing these kind of novel governance systems. You're trying to determine how property is allocated in society, and for the first time we have this ability to conduct kind of experiments especially you'll notice a lot of the governance schemes in crypto, kind of many of them rely in some ways on these concepts from social contract theory, political philosophy. So there definitely is a crossover. I wouldn't say that's how I got into it. I ended up doing after undergrad, I did a sort of much more conventional master's in finance, which was really my ticket in, along with blogging about this stuff and starting Coinmetrics.
Yeah. So what was Coinmetrics? Tell us a little bit about Coinmetrics.
Yeah, so I started that when I was doing my master's. The issue at the time, this was late 2016, early 2017, was a lack of good usage data on major public blockchains. So there were some data sources aggregating, how many transactions are there a day on Bitcoin, and what is the economic value of the flow through those systems? What's like the economic throughput?
Yeah.
Um, and they were very scattered and just incomplete in general. And I was trying to create sort of regressions against usage to compare that to price, to say, well, can I design a model such that I plug in inputs from the blockchain's usage data and essentially train it to see whether it's predictive of price at all. That was kind of the hunch that I had at the time, but the data was basically impossible to acquire. And that's when I got together with an engineer friend, and we started running nodes for Bitcoin, Ethereum, Litecoin, Dash, Monero, et cetera, et cetera. And we took the kind of semi-structured data and translated it into structured, comprehensible, simple data, so that anybody, and you can do this on coinmetrics.io today, you can download these data sets. We're not restricting usage or anything, and you can play with on-chain data to determine, what is actually going on these blockchains, because the idea was that if people had access to sort of the ground truth of on-chain activity, it would allow them to make better decisions as opposed to just relying on white papers or marketing.
Yeah. Yeah. So some of the other ones out there, I mean, I actually, I'm sure I should have known about Coinmetrics, but what's the difference between that and say like a Blocktivity? I've noticed Blocktivity comes up a couple of times where it seems like that's more just activity on the blockchain, but it's non-specific. Is that the difference?
Yeah, I think Blocktivity mostly covers transaction count. I haven't spent too much time on it. I mean, the problem really is the kind of analytical framework is still lacking with regards to really deeply understanding on-chain data. So the risk is that we're just aggregating garbage stats and giving people access to that.
Yeah.
And so what we've always tried to do is be very deliberate in terms of talking about the various nuances involved in analyzing on-chain data and the constraints and the difficulties. So, for instance, there's this popular notion of transaction volume or transaction value. What is the dollar equivalent value of the circulation on a major public blockchain per day? And the estimates for those on Bitcoin and Ethereum will vary over several orders of magnitude because it's just super imprecise. So one approach we've taken, which maybe distinguishes us from some of the other aggregators, is to be very definite about the risks involved in using this data and the constraints and the drawbacks and so on.
Sure. Now, was Coinmetrics, was that before or after you were with Fidelity?
I started that before. I think that was actually part of how I initially perked up my future boss's ears. I think he knew about Coinmetrics,
Yeah.
and then I wasn't exactly meant to do this, but I continued running it on the side while I was there, and then ended up spinning it, actually incorporating it as a business once I'd left, and once I joined the venture fund that we started.
Yeah, and I want to talk about that in a second, but I'm curious about what your experience at Fidelity, and obviously they're now one of the big, the big players that are actually going to get their feet wet in this stuff and get involved. Did that happen? Was there a lot of talk of that while you were there? Were you part of that? How did that all come out?
Yeah, great question. Well, the short answer is that it didn't happen overnight. It was a very long and involved process to go from being skeptical or to put it crassly, ignorant about this asset class, whether it represents an asset class or not, to being one of the leading institutions, in terms of leading the charge. Right now with custody, and in the future we'll see whether there's other products which come out of there. But it was probably about a 5-year process to go from zero to now they have a custodial offering, which I think is quite a distinguished and differentiated product relative to the other custodial offerings. It got started as part of a wargaming exercise in 2013. It was essentially a scenario planning exercise, and trying to guess at things that might happen in the future that might be a threat to Fidelity's business.
Oh, wow.
And one of them was it was called Frictionless Capital Markets, and the worry was, will security settlement end up happening on a peer-to-peer basis? Because that's a really large part of Fidelity's business.
Sure.
And that ended up not being the case, unless we go to this tokenized world. I don't know if we will or we won't, but it didn't end up being the case now, at least. However, that led Fidelity to this notion of blockchains and eventually Bitcoin. So they went through a lot of the cycle that large enterprises go through, looking at the private blockchains and evaluating those projects. And then, interestingly, they felt that as an asset manager, they might as well focus on the assets themselves, the cryptocurrencies, crypto assets. So there were a few initiatives there, but the one that eventually bore fruit was the custody initiative, which I think is a really important piece of the puzzle. And I know the guys on the team there. I think that they'll be probably one of the big winners in the custody space.
Yeah.
They have an extremely professional view on this. They've gone about it in a very deliberate, kind of a risk-averse way. Yeah. So my little group there was actually distinct from the custody project. We were actually a small balance sheet fund, and I was hired to devise research perspectives on these assets. So I'd write long-form research pieces like, what does decentralization mean? What are the dimensions of decentralization? How is it manifested on these networks? How can we distinguish Ripple from Bitcoin, for instance?
Yeah.
Those are the kind of stuff I was writing about. So my goal there was to develop a sort of a systematic and comprehensive understanding of these assets.
Yeah, it's really interesting to me because now, we're talking about Fidelity getting involved with the custodian side, and actually saw today on Twitter a guest that we had on previously with BlockFi. They made an investment in BlockFi, which is a collateralized, crypto collateralized debt, which is also interesting. Again, just these small investments, again, sort of fortifying some exposure to this asset class. And then you've got, Yale's endowment involved. It's pretty interesting. I want to talk a little bit about, now you're with I don't know if you're the founder or you're with Castle Island, and that's it's a venture fund, right?
That's right. We're a conventional venture fund. It's just myself and Matt Walsh. Matt was Fidelity's essentially director of their crypto strategy. So I speak of their journey as if I was there, which is not the case. I was only there from 2017 onwards.
Yeah.
He was there from 2013 onwards. So he saw that whole transformation. And much of I don't know if many crypto believers will believe that what they did was praiseworthy in terms of getting their toes wet in the market. But if you're a skeptic, maybe, you think what they've done is extremely risky. But a lot of their efforts in cryptocurrency are due to Matt's stewardship of that program. So he really has a legacy over there. Castle Island Ventures is myself and Matt. We got started in summer 2018, and we've been deploying capital. We are not an ICO fund. We're not a token fund. We write checks at the seed stage for operating businesses in the cryptocurrency space, either building on top of public blockchains that we think are robust and reliable, or blockchain agnostic, building the sort of associated financial services that we think will need to exist, building exchange tech, custody tech, order management solutions, smart order routing, data. That's obviously what Coinmetrics does, those kinds of use cases.
Right. When you're evaluating these kinds of businesses, they're not necessarily even, like you said, they're not necessarily even blockchain businesses, right? But they're sort of part of the infrastructure or some of the use cases potentially of blockchain. Is that fair?
Yeah, I would say a lot of them are kind of enabling businesses that would be required for this market to mature. So we're still at a stage of relative immaturity. It's very difficult for serious institutions to engage with these assets in a meaningful way, and a lot of the pieces of the puzzle are things like lending, which is what BlockFi did, and that's my old group at Fidelity, were the ones writing that check. Casa is a portfolio company of ours. They help people manage their keys in a way that is kind of robust to various different kinds of shocks. So if you lose a single key, you can recover from that. So those are the kind of use cases that we think are enabling technologies to allow this market to mature a little bit. And then we have other kind of approaches which are more at the application layer, which will use the assurances involved in public blockchains in some way. So, we're diligencing a few companies that are relying on the timestamping function that you get from using hashing data into Bitcoin or Ethereum, which is kind of an interesting feature which didn't exist, prior to 2009, a very robust timestamp database.
Yeah. One of the things that I think about sometimes is that there seems to be maybe an overuse, and this is probably part of that ICO phenomena of blockchain in general, or at least the idea of, blockchaining everything. What's your take on that? Like, how often, do you see businesses that come at that maybe they approach you, or you look at them and they're utilizing blockchain or they're on blockchain, but they don't really need it?
Yeah, it's definitely a condition that afflicts a large portion of this industry. I've definitely been a fairly loud critic of even the word blockchain. It's an interesting trivia fact that Satoshi himself or herself never used the word blockchain. Satoshi definitely wrote chain of blocks, but not blockchain itself. And in some ways, that's just a neologism which kind of borrows, I think, the the reputation of Bitcoin's uptime, and reliability guarantees, and then tries to apply that to what really look like centralized databases to me. And I think it's been abused to some degree by maybe the IBMs of the world, who are using it for PR purposes. I don't think their products look anything like a proof of work blockchain. Um, you know, in many cases, you have consortiums of validators that will come together and take turns signing a database. And to me, that is fundamentally very different from a public blockchain with permissionless validation like Bitcoin and Ethereum are, where anybody can propose a block provided they submit a valid proof of work. So I think there's a really distinct set of ideas there. I think, maybe the private blockchains will be useful. That remains to be seen. But I think it's probably important to distinguish them because in my view, their essential features are very distinct.
Yeah, and then the other question I guess that comes out of that is in which situations or use cases is it important or useful to be permissionless, as opposed to being permissioned but maybe just more efficient?
Well, very, very few use cases is it
Right.
worth undertaking all the additional costs and overhead of permissionlessness. Bitcoiners would say the money use case alone, and then people that like smart contract platforms or computation would say, well, actually, it may be possible to extend this and create versions of Google and Facebook and Twitter that are, run on these distributed computation engines with a permissionless element. I definitely see the logic there too. I just think there's probably a lot more technical challenges to scale before those systems really work. But to me, the main use case we've seen is maybe the most boring one if you're a Silicon Valley investor, which is just the money, the sort of alternative monetary system. So that's the only one that I think has really proved its mettle so far. And then I think it sort of remains to be seen whether we can extend these systems into generalized computation engines. But I'm also optimistic about that.
when you look at the different projects out there, do you consider yourself somebody who's more on the side of being more of a Bitcoin maximalist, or somebody who's sort of who just sees a validity in various projects and who knows? Are you kind of agnostic to that from your perspective?
I
Um,
would say privately, and maybe there isn't much privacy left in this world, but privately, I'm probably, more on the Bitcoin side. Like my own personal stash would be pretty much exclusively Bitcoin. That's the only one that I believe would last me foreseeably 30 years into the future without too much alteration. However, that said, I'm more agnostic when it comes to diligencing operating businesses building on top of these things. What matters, I think, is that they understand the blockchain they're building on very well. You've had a lot of startups that went astray because they were building, for instance, on Bitcoin in 2015, and then their business models required that there were always low fees. And then when the fees crept up, they sought to change Bitcoin in some way, or their business models became obsolete. So I think that's an interesting case where you have to really to build on top of these systems. They're very uncompromising, and you have to understand it very well. So that would be the main thing I'd look for. And then, of course, you always have protocol risk, which is that the protocol itself changes in some sort of unpredictable way. Um, and that maybe also herds you in the Bitcoin direction because what we have right now is a crop of yet to be launched smart contract platforms where their properties are basically unknown. This would be your Definities of the world, your hash graphs, maybe Telegram if they launch. Um, those are just total unknowns. We'll see what happens. And then I guess the risk with Ethereum that I would identify is that they're sort of completely re-architecting the whole chain from scratch. The consensus is being re-architected, the virtual machine, etc. So it may be the case that if you're a startup and you build something that's suitable for Ethereum 1.0, you're kind of out of luck when something really dramatically changes. So those are probably the main things that I'm worried about.
yeah. The question of decentralization in all of this, or permissionlessness, or all this, is really kind of like something I've been thinking about a lot, because I think there's clearly a technology that can make things more efficient, faster, cheaper out there. But there seems like there's this tension between sort of the ideology of, I don't know if you want to call them blockchain people or whatever, but of everything being decentralized and permissionless versus something that maybe has some level of central governance, but the technology makes it smoother. I mean, is there a balance there that you look at potentially, and say, maybe it doesn't have to be perfect in terms of the ideology behind distributed ledgers, but it works better.
Yeah, that's a really great point, actually. I think a great example would be EOS. So
Right.
they have probably compromised I think EOS fans would admit this too, that they deliberately compromised in terms of um, the decentralization of who's allowed to propose blocks. So of course it's limited to a pool of 21 block producers who are voted on by the owners of EOS. So it's more of a either democracy or plutocracy, however you want to characterize it. And then there's the risk that there's bribery, and then it becomes sort of a racket where the larger block producers are essentially buying political support, which is we've seen some scattered evidence of this happening. So that's the risk, right? But in return, you only have 21 sort of economic nodes that matter on the network. And so I'm not exactly sure how the consensus works, but the conclusion from all that is that they can process, 10 million transactions a day. Probably more than that, but that's the most that we've seen in the real world. Whereas Bitcoin does, 300, 400,000 a day, and Ethereum will do up to 800,000. So, I think there's actually a case to be made for sort of very transparently compromising on the decentralized governance side of things to win some scalability gains. I think actually it's an interesting state of affairs where we have lots of different iterations, along different projects on that continuum, and there may be a appropriate balance of both ends.
Yeah, the project that comes to mind when I think about that is actually one that you mentioned, which is Hashgraph, which I've been following, and I look at that as an investor and somebody who's interested in the technology as well. And a lot of the things that Hedera and Hashgraph have been criticized for by the cryptocurrency community is ultimately that, first of all, there's very clear defined there's governance, right? There's going to be these large institutions involved who are going to make up these super nodes or whatever you want to call them. But then on top of that, they're actually, even though it's going to be open for everyone to use the blockchain, or not the blockchain, the consensus network in this case,
Yeah.
the even though it's going to be open to everybody, it is patented, so you can't go fork off and do something else. To me, the utility of that, rather than looking at it as ideology, just seems like, well, gosh, that makes a lot of sense. And then you look at guys like Mance Harmon and these guys who've got a lot of business experience, and I feel like, yeah, maybe they're onto something there.
Yeah, it is a really fascinating question. I mean, I'm definitely in the, full disclosure, probably in the more skeptical crowd when it comes to Hashgraph. But, I think there is definitely a risk that you end up being, the Bitcoiners in particular are blinded by their sort of ideological priors and kind of miss the forest for the trees. And I think, nobody's laboring under the apprehension that Hashgraph is trying to match a Bitcoin for its decentralization. I guess the relevant question is, are they able to strike a balance of centralization and decentralization that is still compatible with their, essentially the objectives of the chain? And I will confess, I don't know what the Hashgraph chain is being designed for, what kind of use cases in particular. My view would probably be that if you're looking to create something which sort of undermines governments, which is an alternative monetary system, then you probably have to max out all of the resiliency and decentralization sliders. But if you are looking to create let's say, a version of Amazon or a version of Facebook, which can't be easily censored by the creator, or where deplatformings can occur, then it could be the case that you can only set those sliders to 75%.
Yeah.
So it's going to be a really fascinating question. I don't know if the valuation is going to hold up at launch. That'll also be something interesting to watch.
Well, yeah, that's the other question. And in their particular case, their whole focus is really, I mean, they don't just talking to Mance Harmon, they don't really consider themselves, competition for Bitcoin. They really see themselves as a faster, more, efficient way of, providing the infrastructure for decentralized, or quote unquote decentralized here, applications that would be more efficient than Ethereum. But I'm curious, I guess from your perspective, also, what is your take on the growing institutional interest in cryptocurrencies in general, in the sense that what effect do you think that that kind of smart money or big money or whatever you want to call it has on the ecosystem at large? Is it a net positive thing, net negative thing, in your opinion?
Yeah, it's been the source of a lot of strife, probably from especially from the Bitcoin crowd. There's always this worry that large that as with the gold markets, where people believe that the gold paper markets are suppressing the spot value of gold, and that the derivatives markets suppress, the spot markets. There's that same worry about Bitcoin, for instance, with fractional reserves being the chief adversary in Bitcoin land. The question is, why would we then reintroduce these central, intermediaries that can issue fractional reserves? And on the one hand, I definitely see the validity of the critique. However, I think the interesting thing with cryptocurrencies is that you can actually audit them with comparable ease. So it's not difficult to provide a attestation which is cryptographically sound and auditable, which says, look, we have $100,000 worth of deposits, and that translates to X many Bitcoins in our cold wallets, and here's a proof that we have a sufficient number of Bitcoins in our cold wallets. And you can create those proofs such that they may be obscure information that you don't necessarily want to share with everybody, but so that people can still verify that you have the appropriate number, of Bitcoins in your cold storage. So I think the issue with rehypothecation worries and the fractional reserve worries with an asset like gold is that it's very difficult to actually prove that a custodian has the number of gold bars in their vaults. But with any kind of a cryptocurrency, it's much more easy to prove this. I'm surprised that more exchanges and custodians are not issuing periodic proofs of reserves. And there's this funny movement happening in Bitcoin land right now where on the 10th anniversary of the chain being founded, so upcoming on January the 3rd, 2019, a lot of Bitcoiners are trying to put together a coordinated run on the bank, essentially.
Yeah.
So I gotta love the cultural events that happen in Bitcoin land. So they're all going to try and withdraw their exchange deposits at the same time and kind of scare the exchanges a little bit into maybe publishing proofs of reserves.
The funny thing about that to me is that the people who are so involved with it probably don't have a lot of Bitcoin sitting on the exchanges in the first place, right?
Well, that's right. I mean, not your keys, not your Bitcoin, so they wouldn't have any on exchanges anyway.
Right.
So I guess they're trying to tempt the traders to temporarily withdraw their Bitcoins. Yeah. But yeah, I mean, to answer your question, I think in general, it's a net positive. If you look at the messaging coming out of Fidelity's digital assets team, they're very attuned to, I think, the issues of the space. They're essentially crypto natives, so to speak. I know the guys over there. They're longtime members of the industry, so they really understand what people are worried about and concerned about. And as more institutional dollars come in, that doesn't necessarily guarantee that the price will rise, but I think it gives us more liquidity. It turns some of these liquidity ponds into liquidity pools. Prime brokerage and functioning less frictional OTC markets will do that, and I think that's a net win for everybody. Generally speaking, more liquidity means less market impact of your transactions and lower fees and just more sort of robust exchanges, and maybe we'll see a transition away from the cowboy exchanges, which are kind of ripping off their users, towards supervised exchanges, which I think is a net positive.
I know you're not following. I know you're not a trader. I know you're not a prophet, but we've obviously had this massive sell-off and crypto winter. And when I look at that as somebody who's looking at what's going on within institutional movement into this area, I would think that would be reflected in market cap, but we haven't seen that. Is that something you feel like it's going to take several years to see that kind of impact, or what's your take on that?
Well, I think a lot of the call it a bubble that occurred in 2017 was due to the expectation of massive inflows from kind of institutional investors, large investors, endowments, hedge funds, conventional hedge funds, right? And I anecdotally am hearing from my friends at non-crypto hedge funds, so these would be equity funds or commodity funds. Oh, now we're thinking about a Bitcoin position, or we're analyzing Ethereum. So interestingly, now that the downturn has come, they're interested again, right? Because nobody wants to buy the top.
Sure.
But yeah, I think the bubble really was a function of people's miscalibrated expectations. It really is a slow process. Keep in mind that it took Fidelity a full 5 years to go from thinking about this seriously to actually having a product out there. That's the kind of pace that these things operate on. And, I've talked to some of the endowments that are operating in the space, and they're not taking a direct cryptocurrency position, because that's typically not how endowments operate. They like to go through managers. So
Right.
they might back a cryptocurrency venture fund or a cryptocurrency hedge fund. So in many ways, it's still sort of indirect exposure.
Yeah,
Um,
I think I remember somebody talking about that with, for example, Andreessen Horowitz has been involved with cryptocurrency projects, and then there's endowments that have been involved with Andreessen Horowitz for years, and
yeah,
so they're getting exposure, but they're getting exposure indirectly.
yeah, I would say the A16Z crypto fund, $300 million fund, is an interesting case where they will take a stake in a liquid live crypto asset directly. They did it with Maker, famously. So you see it flow through eventually.
Right.
And then of course a lot of those endowments backed Paradigm, that large new crypto hedge fund. So I mean it's definitely happening. And I would say the serious wealth managers I talk to are definitely aware of the asset class. But in many cases, the questions are like, well, how do we analyze this stuff? How do we value it? No one's ever come out with a good DCF methodology for
Yeah.
Bitcoin or Ethereum. So I think those funds would either seek to develop those methodologies or wait till there's more agreement or consensus on how that would be done. And there have been there's people that attempt ratio analysis. I've certainly tried myself, but there's not a lot to backstop necessarily the value of these things, for better or for worse, right? So I would say if you had to value Bitcoin, it'd still be based on your expectations of its future market penetration, and what you think the velocity might be in the future. And to many serious allocators, that's not a sufficient answer to the question, and that would keep them from moving in.
Yeah, and yeah, it's funny because I'm on follow people on crypto Twitter, and I uh, hear some tweets from some well-known people in this community, and it says, stick to the fundamentals, and I'm like, well, what are the fundamentals? I mean, I I get what they're
Yeah,
saying,
we've never
but
defined the fundamentals,
yeah,
right?
and we have not been able to value those, so it's a little tricky. I mean, I see value in it as a Bitcoin in particular is the use case being storage of value, but
Right.
I don't think fundamentally there's a way to to quantify exactly how much it should be worth at this point.
It's something that I struggle with. I think about it a lot. Ultimately, maybe it shouldn't be the case that it's hedge funds buying it opportunistically. Maybe it should only be purchased by users that can really benefit from the actual attributes that it has. So, and people, of course, are going to try and guess at what that population, that interested population, might be. But I think a more authentic value might just emerge as a function of people learning about the chain and finding out what they can do with it that they can't do with the legacy financial system. But of course, it's extremely hard to model that adoption process.
Right. So, Castle Island, are you guys? How big? How big a fund is this? Who are your investors? Are you institutional nature? Are you investors?
Our LPs, so actually Fidelity came in as our largest investor, so kind of a harmonious decoupling there. And the remainder of our LPs are mostly high net worth individuals in Boston. We raised 30 million.
Cool. Very good. And how do we learn more about your work, man? What are you? You're pretty active on Medium, I noticed.
Yeah, so I spend my weekends thinking about cryptocurrencies and blogging about it on Medium. That's probably the main place to follow me. Do the occasional podcast here and there, but really, I like to do some more sort of data-driven work on Medium. So I did one where I compared the TPS, the transactions per second, of a whole bunch of blockchains, and then actually legacy financial systems like Swift and Fedwire and ACH. And then I also compared it to the typical transaction size, so like what would be the average physical cash transaction. Apparently, it's around $20. And what's the size of your average Ethereum transaction, and what's the size of your average debit card transaction. So I compiled that all into a single chart. I was trying to compare all those different payment and settlement systems. So that's the kind of stuff that I'll do.
Who won?
It depends. You've got the ones with really small transactions, but there's tons of them, and you've got the really big transactions, but there's
Right.
not that many.
Right.
Yeah, there's kind of it's two axes,
Right. Well, listen, it's been really fun talking to you, Nic, and I want to thank you again for being on the program.
Thank you so much. It's been a pleasure.
I'll be right back. Welcome back to the show, everyone. I think Nic is a really smart guy, really thoughtful, and it was really fun to talk to him. I'm going to go into some questions that you guys sent me now. The first one is from William, who is a listener of Wealth Formula Podcast as well. He's asking, hey, it's Will. Absolutely love the website podcast. It's my go-to in regards to crypto updates with the Altager crypto trader coming in a close second. But I do have a question. First, thanks for that. I want to point out, William, that this podcast is worth every penny that you pay for it, too, compared to that particular newsletter. And I'm just joking. Actually, there's nothing wrong with the newsletter that William is talking about. It's James Altucher, but it's also it's Kamal. I believe it's Kamal Ravikant. It's Naval's brother, and he's deeply involved in that whole Silicon Valley blockchain distributed ledger world. And so I'm sure there's significant value to it. So I don't mean to be knocking on that, but anyway, the question is, can you explain blockchain, William? That is the broad question. It seems like several companies are about to use blockchain, in quotes, technology in their business. However, it seems like they are developing their own. If companies are choosing to develop their own blockchain and ledger, what is the purpose of Bitcoin and Ethereum? Well, actually, the latter part of this is a really good question. So I would put it this way, and I think it has a lot to do with sort of what we were talking about here with Nic. First of all, a lot of companies are using the name blockchain when maybe they don't have anything to do with being part of any kind of consensus network. And then on top of that, they have these companies, like, for example, that are, IBM is doing their own little network within IBM that they can use, and banks may do the same thing. Through some of the projects that, for example, Chase is working on, which are built on Ethereum. Now, I think the best way to think about the question about using it in, if a company's building a blockchain of their own, why will that replace Bitcoin and Ethereum? The answer there is no. And the reason is that I think the best parallel to that is that when the internet came along, a lot of companies started building intranet projects, right? So they were like, oh, we don't really need the internet. We can do all these things, in our business with an intranet, which basically connects their own computers, but not with the rest of the world. A distributed ledger with consensus mechanism, which really is what's powerful about this whole thing. In order for it to be really useful, does need to have some kind of distribution, right? It can't just be like a few computers in an office or a business, because if that's the case, then it might as well just be, one ledger, right? It might as well just be an Excel spreadsheet. The whole idea behind these distributed ledgers is that they're sitting on thousands of computers across, the world that, are not part of one business. And there's this consensus that occurs and across these computers. And that's what makes it so you can't hack it. That's what makes it so that it can't get hacked, because you'd have to go into every computer in the world to go back and change the data that's already there. And so that is the value of consensus mechanisms, distributed ledgers. Now, blockchain is just one type of distributed ledgers, and you heard Nic talk about how he hates the word blockchain as it's used currently right now. It's sort of used all over the place. But anyway, that's the idea, is that, if you're truly doing a project that requires consensus and immutability and all that, you have to have something that is sitting on a lot of different computers across the world in order to make it immutable and give it all the other qualities of something like Bitcoin or Ethereum. Now the purpose of Bitcoin and Ethereum themselves is really, right now at least, quite different, right? Bitcoin, for the most part, right now, is some sort of monetary instrument, whether that is a storage of value or whether that's a currency. There's people who argue about that, but really that's the main use purpose. That is the use purpose for it right now. Although arguably they can build on top of that blockchain. You can build more complexity, as you see companies like Blockstream doing. You see Samson Mao last week building on top of this blockchain. Ethereum, on the other hand, was really built for the purpose of being a lot more flexible in terms of a platform that just people could use and program smart contracts into. Of course, to me, right now, I have to tell you personally that I actually hold virtually zero Ethereum. It's not, either alts or in Bitcoin. But it was a great way to get involved with projects because it's easy to do. But I don't really, until Ethereum does something to change its scalability, I'm concerned about even its role in the smart contract world. So anyway, hopefully that's helpful to you, William. Now let's see, another question. All right, so the next question is from Nigel from the UK. And Nigel writes, "Hi, Buck. Could you clarify the token economics of WAX, which is, of course, Worldwide Asset Exchange, one of my projects of interest? He says, I don't understand how it will increase in value unless they receive a share of the transaction fees. To me, the WAX token is exactly the same as the Binance coin, which is BNB. And from my understanding, holders of Binance coin receive dividends, but I could not identify from the WAX white paper if WAX did the same. So I actually thought it would be interesting to get an answer from WAX themselves. Of course, I could have answered this, but it wouldn't be nearly as eloquent and not coming from Malcolm Cassell himself. But here I forwarded him, and this is how he answered it. Buck, Binance Coin does a buyback from profits, which we have not ever said we would do. So that answers that. So there's not that. Our consensus model, as you know, is called Delegated Proof of Stake, or DPoS. We borrowed it from EOS. In consensus structure, coin holders can stake their coins to block producers and receive amounts back from what the block producers earn. Additionally, our system requires staking for guilds, escrow, appraisal, and other marketplace services. Remember, all this stuff you're not seeing yet because, the mainnet, is not really, you don't have the tokens yet that can do all this stuff. You have ERC20 tokens. Now, each of these functions will return some amount of their generated amount to the stake tokens by definition. He goes on to say, I believe that most of this is in the white paper. And then he says, keep in mind, the current token is an ERC20 token, as I mentioned before, too. And so it does not have any of these functions. The mainnet token will be connected to all the things that I reference above. And of course, the ERC20 tokens, people who hold those will receive the mainnet tokens in Q2. So anyway, I would suggest going to wax.io and checking out some of that information if you want. But, this is a pretty robust project with lots of ways basically to create value, and I think ultimately to drive up the value of that project. I still am that is one project that I am Gosh, I'm just waiting to me that for that one to how it responds when there is some kind of bull market in Bitcoin again. I think that's going to be one of those that is just going to fly. But anyway, that's it for questions this week. Make sure to send your questions to info@consensusnetwork.io or go to consensusnetwork.io and use and you can write questions there. You can also leave a voicemail, and that's actually preferred, although nobody seems to want to do that. But I would suggest you do that. Be great to hear from you. And that's it for me this week on Consensus Network. This is Buck Joffrey signing off.